I think you'll see the gold-silver ratio fall quite rapidly, well below 80, well below 70, well below 60. I see it falling below 50. I don't want to put a timescale on it, but it does mean that you could be buying, when you switch back into gold, in effect, you're buying twice as much gold at the future price by leveraging it up through silver.
You can only suppress the price or manipulate a market for a long extended period of time by pushing it in the direction that it is going. And if it starts to move the other way and you're still trying to cling to the same program that you've done in the past, that's when things get very dangerous. And that's where we are right now. I would argue that will end badly, and you'll see prices go much higher.
Gold is once again rewriting the record books, pushing higher midday Wednesday and dragging silver with it. Silver just hit another 14-year high, but analysts say the real story is still ahead. Alasdair Macleod, head of research at Gold Money, argues that silver remains the most undervalued metal on the board. Strip away its monetary role and the fundamentals are undeniable. Solar panels, medical equipment, defense systems, antimicrobial uses, and unmatched electrical conductivity. By that logic, he says, silver should be priced higher than lithium. Instead, it trades like a forgotten relic, dirt cheap compared to its industrial importance. The leverage comes when gold breaks out. As prices press beyond $3,500 or $3,700, latecomers unwilling to chase the yellow metal will flock to silver as the cheaper alternative. That rotation historically drives the gold-to-silver ratio lower first through 80, then 70, 60, and possibly even 50. Each step lower multiplies the upside for silver holders, effectively turning it into a leveraged bet on gold's advance. Macleod also points to the bigger geopolitical stakes. If fiat currencies weaken far enough, nations like China or Russia could eventually peg to gold to stabilize their systems. Such a move would fundamentally reset global trust, pushing gold into the center of monetary architecture and leaving silver riding in its wake. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
I did a bit of analysis on the relationship between gold and base metals, and sort of indexing them back to about 1900. You look at the value of a basket of base metals, and they are about 25% of that 1900 value measured in gold. Now, this is important. Okay, gold is maybe a bit ahead of the curve in these circumstances. One can understand that. But the basis of the suppression of base metal values has been the inflation of credit and the falling purchasing power of credit values not being reflected, if you like, in the value for these metals, for a basket of metals. So even measured in gold, the potential rise in base metals could be as much as 300 or 400%. And that is without considering gold rising. Now, so even if you regard silver as a base metal, without considering any of its monetary qualities, any of its monetary history, you can see it's wildly undervalued, particularly because of its really quite extraordinary properties. It's the photovoltaic cell industry is just booming. Defense, etc. Also, the sort of antiseptic qualities, the way it kills bug germs and all the rest of it. I mean, there's so many uses of it. It's the best electrical conductor, the whole thing. This is, I would say, it should be more valuable than even lithium. So on that basis, silver is very, very cheap. And we have the situation where people are beginning to realize that gold, they'll sort of think, well, gold is going up again. And when gold is going up again, how do we play this? I mean, can we really afford to buy gold, say, at $3,700 or whatever the day-to-day price is? It's probably easier to get into silver because silver's got left behind. So I think you'll see the gold-silver ratio fall quite rapidly, well below 80, well below 70, well below 60. I see it falling below 50. I don't want to put a timescale on it, but it does mean that you could be buying, when you switch back into gold, in effect, you're buying twice as much gold at the future price by leveraging it up through silver. Well, you will get some volatility in currencies relative one to another. Of course you will. I think sterling is horribly overvalued. I can see that collapsing ahead of everything else. particularly when Rachel. Really, I think the interesting thing is that China and Russia have gold. They've got lots of gold. I understand that in two wealth funds, Russia has a further 10,000 tons of gold, which could deploy, if you like, on the central bank's balance sheet. So they would have about 12,000 tons, 13,000 tons. That's Russia. I reckon that by 2002, the People's Bank of China had accumulated gold in the big bear market from 1983 onwards. When it was 1983 was when legislation was passed appointing the People's Bank of China to handle the nation's gold reserves. And between then and 2002, Chinese individuals were not allowed to buy gold. So they had a clear run at it. And they tucked this away, not on their own balance sheet as reserves, but they spread it around. My information is that it's gone into things like, for example, the People's Army account and also the Youth Communist Wing's account and so on. So it was all spread around. I reckon they could have accumulated a good 20,000 tons by 2002, which they then turned around and said, okay, we're going to set up the Shanghai Gold Exchange and individuals can now own gold. And they have been accumulating gold ever since. And if you look at the withdrawals from the Shanghai Gold Exchange, they total around about 27,000 tons since 2002. So China can go onto a gold standard, I think, quite quickly. The reason she hasn't is she knows that if she goes onto a gold standard, she will destabilize the global dollar-based fiat currency system. And that's not her style. She rather watches America make all the mistakes. I mean, it's Sun Tzu or whatever.
Never interrupt your enemy while he's making mistakes.
Absolutely, Tim. Yeah, that's absolutely right. So that's their view. They've got Russia in tow as a very close partner, running this huge, great circus, which at the moment is 70% of the world's population. This is where the future is. This really is where the future is. And I think that there will come a point when China and Russia will put their currencies onto gold standards to protect those currencies from the collapse in our currencies. So it's probably not all that far away now. It's a question of progress and what becomes acceptable to the counterparties that you're dealing with. And also, when we set out colonies and dominions and all the rest of it around the world, you're dealing with all sorts of people, not just your local community. You could do it. You could do local community just purely on credit. There's a fascinating story, which is well documented, that in Guernsey, the States, which is the government in Guernsey, back in 1770-ish, something like that, decided they needed to build a new meat market, which now is still standing there. It's now mainly the co-op and offices and so on. This was going to cost, I think the figure was something like £4,000. So what they did was they issued tickets which could be used as currency. And the tickets were, I think, £10 each or something. So they issued enough tickets to pay for the cost of the building. And out of the rent, they were able to redeem these tickets over the following 10 years. No money was involved. No money was involved. It was just done on credit.
Gold's rally doesn't look like a bubble. It looks like the definition of a real bull market. Prices grind higher, pullbacks are shallow, and every dip gets bought. That's the picture Andy Schectman points to today, and it's not being driven by retail frenzy, but by heavy, sustained physical demand at the top. What makes this cycle so unusual is the lack of fanfare. Gold is already sitting near $3,500, yet most people aren't even paying attention. Schectman says the average person wouldn't recognize a gold coin if it were in front of them, which tells you how disconnected the public still is from the move. Quiet accumulation at high levels is a textbook contrarian signal. The smart money is already positioning while the crowd remains distracted. Silver tells the same story, maybe even more dramatically. At $42 today, plenty of investors would have been ecstatic just a year ago, but Schectman sees this as the early innings. Governments in Russia, China, and India are aggressively stockpiling silver, with demand spilling into Western markets too. Unlike gold, silver has a dual role. It's money and it's critical to industries like solar, defense, and medicine. Let's get back to the interview.
But when you have such large short positions, that can be a very big problem. You get short squeezes, then you really get prices moving in a vertical parabolic fashion. Nickel's a good example, except they basically reversed all the transactions, and as far as I'm concerned, LBMA lost all credibility when they did that. But that's what happens when you mess with Mother Nature and you suppress all of these things for, ill intent. The markets need to operate freely. Free markets seem to find equilibrium where they should be. When you suppress the freedom in free markets and allow these distortions to happen, that's why all manipulations end badly. You can only suppress a price or manipulate a market for a long extended period of time by pushing it in the direction that it is going. And if it starts to move the other way and you're still trying to cling to the same program that you've done in the past, that's when things get very dangerous. And that's where we are right now. I would argue that will end badly, and you'll see prices go much higher. You'll see whether it be hedge funds or commercial banks go under as a result of their stupidity to short all of these. It's an existential threat. One could argue this is what put Bear Stearns out of business. So to me, you just play the long game, and it's been a long, arduous journey to where we are now. But if I would have told people, a year ago that we'll be staring at $42, in early, mid-2025, I think most people would have been happy about that. Quite frankly, I think it's just beginning. We're a long ways away from seeing where this ultimately stops, but this is where it should have been a long time ago, and I think it's still got a lot of room to run based upon everything that I'm seeing, whether it be anecdotally or economically, or just by the movements of the biggest players in the world with Russia and India and Saudi Arabia and China. They're all gobbling up silver as fast as they can. Evidently, so are the folks in the United States now, too, at least on the COMEX. When that translates to the retail side, which I believe it will, something will wake up the public, that's when we'll see real fireworks. And of course, we're not there yet, but that's a benefit to all of you who are trying to add to your portfolio before the prices get out of hand. Well, I think a real bull market is one that continues to move up gradually, kind of like what we're seeing here. I would argue the difference right now between this market and ones in past is the corrections. The corrections are nowhere near what they were before, where you would see a correction and the price would get stepped on and go lower and lower and lower, wouldn't come back, like in 2011. The corrections that we are seeing now are very shallow. While they can be steep, they don't last very long. Then the price comes right back. That is an underlying reality of physical demand at the highest levels. What's unusual about this one is the price. If you would have told me gold would be at $3,500, and most people wouldn't know a gold eagle if it fell on their foot, is shocking to me, which tells me we're very early yet in this bull market. But a price that continues to move higher without gaining any attention, to me, is very bullish, because it's the biggest money in the world that is pushing it higher as the public is moving it completely and totally lockstep in the other direction. It's, to me, very, very bullish and a contrarian indicator that this is indeed happening. Uninformed and hypocritical, because these are the same people that are all in equities at all-time highs, at the highest valuation since the 1929 crash, held up by 7 stocks, where the rest of the stocks in total are barely up at all on the Russell 2000. It's just naive as far as I'm concerned. And it's the fact that people don't understand that, yes, gold is at all-time highs or damn well near it, but because of overt suppression to make the dollar and the bond market look better than it is, or they are, no one knows how high gold and silver should be. But this is exactly the sentiment you would want if you're already positioned, because this is why so few investors ever make money. They miss the important part of the equation. The fundamentals, they don't understand, and they just look at price, which is the ultimate tool of misdirection. That's why they do it. The big money knows that they can mess with the price and everyone else just keeps on walking. The people who understand value, understand math, understand logic, they take the time to apply it to this thesis, to this idea, would walk away saying, yeah, that's exactly why the big money is accumulating it quietly. This is the don't do as I say, do as I do. I would say that those people who are making that assessment are making a very foolish and ill-informed, hasty appraisal of the situation.
I know we've talked about this before, but I want to loop back on it again. This is the ordinary moms and pops we're talking about at the moment, but there are a significant layer of money managers above that layer of retail investors who are shepherding the endowments, the retirement plans, the pension plans, the insurance funds to underwrite, to backstop, supposedly, millions of people's nest eggs and retirements. What's your view of the awareness at that level, evidenced by what's been going on in terms of investment demand in the face of this accumulation by the largest players in the world?
They don't have any idea either. I mean, the market continues to move higher, and, it's without any regard for risk, or a risk of prevention or aversion. So I think that the pensions are in very big trouble. I mean, where do they get their yield? They're forced into the equity market because they're not getting it in the bond market. They're forced into the equity markets at all-time highs, at all-time valuations. And I think this in and of itself is scary because, I believe that especially if we see a decrease in yield or rates, you got valuations at literally 1929 style extremes. You got all of the insiders, the veterans, Gartham and Buffett and Dalio. They're all talking of highlighting systemic risk. You have insiders selling, as we've talked about, the industrials, or the institutionals rather, Bezos and Zuckerberg unloading billions in stock. And I just think that this is a very, very dangerous time where the insiders are moving out, but the hedge fund or the pension funds don't have much choice but to speculate. They're not getting the return that they had thought they would with treasuries or had hoped for, so they have to, at that point, speculate into the equity markets as some of the most informed money in the world is moving in the other direction. And buying gold, which doesn't pay a coupon, even though it's outperformed everything, they won't even look at it. They won't even think about it. So it's putting a lot of people and their future in trouble, in jeopardy.
The Federal Reserve is set to decide on interest rates at its upcoming FOMC meeting in the next few days, with investors and analysts highly expecting a rate cut following signals from its chairman, Jerome Powell, that the central bank may finally cut rates. Any cut could weaken the US dollar and make it easier for overseas buyers to purchase precious metals such as silver and gold. Striking in this moment is how both metals are rising not from hype but from forces that appear structural and enduring. Gold's steady climb without retail mania suggests deep-pocketed accumulation, while silver's surge underscores its growing necessity in technologies that underpin modern economies. Together they hint at a shift in how capital is seeking safety and utility at once, carving out a new role for hard assets in a world where currencies and policy credibility look increasingly fragile. If central banks do move toward easing, the stage could be set for even greater flows into these metals, not as speculative trades but as anchors in uncertain waters. The convergence of monetary shifts, industrial pressure, and geopolitical maneuvering gives gold and silver momentum that feels less like a passing phase and more like the early chapters of a reset. The pressing issue is whether this strength marks a durable revaluation of precious metals, or if another policy twist will test how firm this foundation really is. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.